Hello and welcome to Market Domination. I'm Josh Lipton, live from our New York headquarters. It's just now to go until the closing bell, and stocks are lower here ahead of a busy week on Wall Street with tech earnings and, of course, the Fed's final meeting of the year. Let's welcome in now Jared Blickery, joining us to break down the headlines. Jared, what are you seeing in the markets?
A little bit of downside action in the majors right now. Dow Jones Industrial Average down about 0.5% or 266 points. NASDAQ down a bit less than that, 38 basis points. And the S&P 500 just about exactly half of 1 percentage point. And I will show you the intraday price action. We started off in the day, this is the S&P, barely in the green, and we sunk to lows, and we just recently hit new lows about an hour ago. And we're just off of those right now. Not a huge move. And I would also add that the Russell 2000 has turned positive. So we'll see if the majors can catch up with the Russell there. And let's take a look at, actually the VIX, because that has been creeping up just a little bit. And we have that here, 16.8. So that's not a huge move, but something that's kind of going in the wrong direction. So we pay a little bit of attention to that. And then in the bond market, we have seen longer term yields creep up over the last few days, maybe even 2 weeks. And you can see it's up another 3 basis points in a 10-year. That is to 4.17%. The 30-year up 2 basis points to 4.81%. And here is that 10-day trend. You can see kind of from the lower left to the upper right. Meanwhile, the U.S. dollar index tacking on some very small gains over today. You can see it's still red over that 10-day period, but just barely green today. And let's take a look at the sector action. Tech is the only sector in the green. This is its 11th straight day of gains. We'll see if that statistic holds into the close. Also, well, no, not also. Everything else is in the red. So let's start with the bottom, consumer discretionary. That's where you see Amazon and Tesla. That is down 1.5%. XLB is materials, that's down 1.4%. Healthcare, energy, utilities, communication services, all of that bottom row, all of those sectors down 75 basis points or more. And taking a look at the NASDAQ 100, we got Nvidia back in the green today, Microsoft there as well, Broadcom up about 2%. Meanwhile, Tesla is down almost 4% right here. Alphabet down 2.5%. So a mixed picture for the mega caps. And you can see a little bit more red than green on this board. I'm going to drill down into the tech sector, starting with the semiconductors. So the semiconductor space looking pretty good, at least with the bigger names. If I sort by performance, you'll see a little bit of red show up down there to the bottom. Marvell looks like down 7%, Intel down 3%. Those are the only dark red squares or rectangles that you see. Here is software, and we're seeing kind of a mix between red and green here. Besides Microsoft, also seeing Cisco up 1%, Atlassian up 1%, Twilio up 2%, MongoDB 2%. Not a lot of huge upside action, or to the downside, I should say. And then also ARC. I do like to look inside the innovation. Besides that big one, Tesla there down 4%, as I went over before. A little bit more green than red. And one of the things I noticed recently is we saw some moves into the speculative parts of the market, so I do like to bring up what the meme stocks are doing. And here I'm going to give everything an equal weight. You can see a pretty equal split between red and green, so not huge risk on today, but look in the upper left there. I'll just pull up Carvana. Lots of talk about it finally joining the S&P 500, 13% today, 122% year to date. And here's a max chart. Always blows my mind here. From that peak in 2021, was able to exceed it and then some very recently. Go for it.
All right. Thank you, Jared. Appreciate it. Wall Street eagerly awaiting the Fed's last rate decision of the year. And while markets have had a shaky run into the last stretch of 2025, strategists remain positive on stocks in the new year. And our next guest is one of the biggest market bulls of them all. Let's welcome in Oppenheimer Asset Management Chief Investment Strategist. That would be John Stolfus. John, always great to see you. So let's dig right into this, John. So your 2026 target for the S&P 500, you put a number on the board, John, 8,100. What gives you the confidence, John, we're going to see that kind of move next year with the SPX right now around 68.34, John?
Well, we've got to consider, Josh, that when we look at the market since the fourth quarter of 2022, when we saw the market beginning to rally off of all that negativity that we had for the first 3 quarters of 2022, the market has repeatedly shown resistance to falling to the temptation of negativity. It has found resilience in economic data as well as in earnings. And so as we move into 2026, we expect some of the trends that exist in this period of really very significant transition, whether it has to do with monetary policy beginning to change to a looser regime, in essence, as well as fiscal policy, and with the Trump second administration decidedly different from the Biden approach in fiscal policy, but both really very much providing liquidity, we would say. We've got to think that it's going to be good for corporates and it's going to be good for the consumers. And it'll be reflected in stocks rising probably somewhere about 14 to 17% overall next year, depending upon which gauge you look. If we get to 7,100 by the end of the year, which is our target for this year, it'd be about 14% upside for next year, 17% from where it was, as I recall, on Friday's close.
John, let me ask you, and I'm sure you got this question from clients as well, just how you're thinking about valuations, John, and whether could we be underestimating the risk of things looking fairly stretched here?
Yeah, Josh, I think that when we look at third quarter earnings up 12.9% earnings growth third quarter year over year on back of revenue growth of about 8%. When we look at that kind of a situation and the prior 3 quarters to it, it just tends to be full of positive surprises. We would have to say that we'll have to watch as we go forward here, interpretations of changes within the market in terms of valuations. Where we are right now, I mean, my gosh, this is looking for a multiple of around 25, 26 times for next year based on a forward projection of $305 worth of earnings and an $8,100 target. Looks pretty wild, but we would expect earnings will grow ahead of expectations, ahead of our 12% growth in earnings. So we think it'll be still relatively rich in terms of historical. But I've been in this business for 43 years, and what's decidedly changed is the way investors invest. Traders are still short-term oriented, generally leveraged with the ability to throw down perfectly good stocks as well as bad stocks like hot potatoes on any kind of catalyst that they see. But the long-term or intermediate-term investor, 2, 3, 5, 7 years and beyond out, what they're looking for is the ability to provide for things like retirement, kids' education, in a world where Social Security and benefits at corporations are not the same as they used to be 40, 30, 20 years ago. And so as a result of that, they're investing like investors that are conservative investors. And when they're looking for the better stocks, and you're in a world where if you listen to Ed Yardeni, the well-renowned economist, there aren't enough stocks to fill the Wilshire 5000 anymore as a result of the last 30, 40 years of private equity, as well as mergers and acquisitions and consolidation in sectors. So good stocks, you're liable to be paying more per dollar of earnings than was quite normal just 20 years ago, 10 years ago. For boomers, 16 times the forward multiple looks reasonable. For investors who are older than the boomers, they even think stocks are cheap only when they're at 12 forward multiple. But the younger generations tend to begin pushing that multiple up, and even the boomers are willing to pay more. And it's much like economics 101. It's supply and demand. Now that's outside of the memes. It's outside of the crypto. This is the serious money that's invested for things like being able to remain at a certain standard of living in retirement. And so you're looking for higher quality stocks and most likely willing to pay more for each dollar of earnings. And as well, I must say one more thing, because your question was a solid question, Josh, is also the rally is broadening. Industrials, financials are beginning to really enjoy the process of this rally process that began back in 23. It's a much broader performance that we're seeing. Tech isn't the only hero on the stage. It's sharing space on the stage in the performance circle.
John, you mentioned monetary stimulus earlier. Of course, Fed decision on deck. How important, John, is a cut this week for the bulls? And how many cuts, John, are you penciling in for 2026? What is your base case there?
Yeah, Josh, we'd have to think that the Fed is going to cut 25 bips, and we think it is important in the sense that the Fed so far has shown great sensitivity to delivering on its dual mandate, essentially providing an interest rate regime that allows for sustainable growth at a pace that can grow the economy in a healthy fashion without creating untoward levels of inflation, while at the same time not upsetting the apple cart of producing jobs in enough to keep us from a situation where we would see unemployment rise significantly and job creation fall. So where we are today, we think it's 25 bips. We do recognize that the argument among the hawks and the doves in terms of how they're going to vote at this FOMC meeting is much more pronounced than before. But we think that ultimately Ben Bernanke will deliver another cut in what we call a down payment for both Wall Street and Main Street. On Wall Street, it's for the leveraged players and just generally the institutions. For Main Street, it's those people who are looking for more affordable mortgages as well as more affordable consumer loans, while not going to the extreme and taking that risk on inflation that continues to appear somewhat sticky, even though that PCE just delivered last week, what was it, 2.8 to 3% is really your gauge for inflation growth right now, which is a heck of a lot better than it was at 9.7% when the Fed began to address this in March of 2022.
John, you said Ben Bernanke there. I know you meant Jay Powell. Both very impressive men, John. So it's easy to get confused. Let me get you out of here.
Let me tell you. Bernanke has left a legacy that's important to remember, and we think that Powell very much follows the Bernanke legacy.
John, I want to get you out here on this. We're talking stocks. In your note, though, you also did talk about gold. Incredible run this year. Of course, crude, as you point out, John, is going the other way. What do those moves suggest to us as an investors? What are they telling us?
Marvelous question. With gold, one would often think, it's a question of investors hedging against inflation, also hedging against the possibility of the dollar falling further should the Fed continue a policy of rate cuts. But at the same time, the effects on gold really have to do with you've got major central banks in the emerging markets, China, Russia, Saudi Arabia, India, and other emerging markets. Their central banks have been buying gold to support their currencies competitively versus the dollar, which has proven strong even through crises like the great financial crisis, like the COVID pandemic, and just the process of a lumpy transition from the COVID period through the supply chain disruptions and all, and then Ukraine, and then various things that happen around the world in the Middle East, for example, wherein the dollar remains where investors go when they really get worried. But on a day-to-day trade basis, the emerging markets are trying to build their own Silk Road, not just China, but sort of an other road of trade to compete with the U.S. And the way they're looking to do it is supporting their currency, so they can try to take away a little bit of the glamour from the dollar as the reserve currency of the world. And that's supporting gold in the biggest way that we can see, and likely will continue for some time.
John, I am always lucky to have you on the show. Thank you, my friend.
Thanks very much, Josh. Great to be here.
Coming up, we zero in on the latest executive departures at Apple and what the changes could mean for the company's business. It's coming up next. Apple is contending with a wider shakeup in its executive ranks, but the company's chip chief is reportedly clearing the air over his departure. Rumors, Johnny Srouji, who oversaw Apple's pivot to in-house silicon chips, says in a memo to staff on Monday that he does not plan on leaving the company anytime soon. Here to discuss, got Creative Strategies CEO and principal analyst Ben Bajarin. Ben, it is great to see you. So let's go over this, Ben, because we had sort of competing headlines here. So Bloomberg reports Apple exec Johnny Srouji told Tim Cook he was seriously considering leaving in the near future. That certainly got a lot of attention because he is, of course, Apple's chip guru, well-known, well-respected. But then today, per reports, Ben, he tells staff no, he's not leaving anytime soon. What did you make of these competing headlines, Ben, the back and forth? It would, of course, be a blow if he was leaving, Ben.
Yeah, for sure. I mean, I think Johnny Srouji is super well respected, obviously played a giant role in their architecture transition and a lot of their custom silicon efforts. So I think there's obviously a sigh of relief that, it is confirmed that he is staying. I don't know what to make, from reports. I mean, obviously there's been a lot of noise lately about a number of executives both departing and then some of the secession and retirement plans of others. So I don't expect that to calm down anytime soon. I mean, I do think everybody is anticipating some continual bit of leadership change as to set the next structural era for Apple in terms of executive leadership. But on this part, at least, it's nice to have it confirmed that that their chip chief stays in place, at least for now. But again, I think there's a lot of things structurally going on, with this company that just continues to validate kind of the deep bench stuff that we've talked about before. I'm a lot less concerned about that as a whole. But obviously, we're waiting to see what happens in terms of future leadership changes over the next couple of years.
Well, I guess, Ben, you're sort of referencing this, but these recent departures, Ben, we've seen in Cupertino, CFO, COO, the GC. I mean, if I'm an investor in Apple, I guess bottom line, Ben, am I watching that and is it a source of concern at all in your opinion, or no, listen, these are tested veterans. They've been in Apple a long time. They have made a ton of money and they're retiring.
Yeah, I mean, I think we've talked about this, right, for a couple of years. Everybody's noted, right, at the top, Apple has had a lot of their executives have been in this for a long time and are obviously getting older. And so I think there was an expectation at some point, because it was concentrated, right, toward the top, that we would see some of these transitions. I don't think anybody expected them to happen at once. It would be things that go along phases. And, again, right, to the question of, like, should we be concerned? I mean, I think there's always going to be a wait and see, right? I mean, Apple thrives and their success is on their dependability and their consistency to put out quality of products. I think my only concern would be if we saw multiple generations of products not meet that bar, and that's not in jeopardy at the moment.
We talked, so the CFO, the COO, the GC, Ben. Also, though, there was a shakeup in the AI ranks there as well, some big names. Coming ahead, Ben, when we expect some big AI news next year, new and improved Siri, I'm curious what you made of that change specifically.
Yeah, I mean, I think the AI talk has been good. I mean, there's been a couple of people who were reported to also come on to the team who both have extensive backgrounds, and then some related to Google. If there's any, truth to this rumor that they're going to work closer with Google for some of the AI stuff, not all of it, but some of it. I think again, right, you come back to Apple is not, like OpenAI or Google when it comes to Gemini. Like that's not the core of their business. So if you have AI talent who wants to be in that kind of a frontier model, something like what OpenAI is doing, maybe even to Meta, right? Apple's just not going to be that place, right? And so I think finding the right fits for both the culture and the product strategy for AI is going to be key. And that's where we'll continue to see people who join that team because they believe in that vision for what's going to go on with device, hybrid cloud, their approach to agents, which again is just going to be different from others.
Let me ask you, Ben, your expectations for this Siri update. Here was a note from Evercore, Amit Daryanani and his team, putting out a note saying they expect Apple to launch Siri 2.0 in the spring, Ben, bolstered with a Google Gemini partnership. What do you expect to see there, Ben? And listen, if you're an investor, you're wondering, is that going to be enough to drive a meaningful iPhone upgrade cycle? What do you think?
Yeah, I mean, there's two things, right? I think there's this conversation around, LLM and chatbots, which are great. I think people get a lot of value for this. The way they use those products today, whether that's OpenAI or Gemini, is largely a version of search, right? You want information on something and you chat with this agent or this LLM. I think there's another side to this where you kind of have this co-collaborator, this agent that knows about you, has memory about you, has maybe intimate details about your life, which is where I think the privacy part of this comes into play. And that part I think is going to become a lot more valuable for consumers when it's not just using this like a version of search, but using it in your day-to-day, automating tasks for yourself. It might be able to anticipate your needs. And that's really what I think Apple wants to do. And so I'm hopeful that what they'll do is they'll have something, right, like the kind of bigger Gemini, OpenAI stuff with the partnership, and then more of that really intimate, collaborative agent that can do things for you, intimately knows you, and adds value on your behalf, which is kind of what my more expectations of what a Siri agent might feel like in this 2.0.
Ben, always great to have you on the show. Thank you.
Likewise, man. Good to see you.
Now time for some of today's trending tickers. Yahoo Finance's Brooke DePalma joined me here for a look at Carvana, Strategy, and Wave Life Sciences. We're going to start with Carvana, the online car retailer, seeing shares surge as the stock is set to join the S&P 500. So this one, Brooke, okay, so join the S&P 500 starting December 22nd. Analysts weighing in here. I see B of A, they raised their price target on the name. They go to $455. They cite the announcement, maintain the buy, say Carvana, they say has been eligible for inclusion for several quarters now. We first saw inclusion as a catalyst, they say, back in June.
I mean, this stock had quite the run. Think about where we were, where it sort of was getting mixed up in that meme stock trade. And now on its own, it's increased more than 120% year to date. The average price target on the street is now actually below where it's currently trading. It's at $427 for the 12-month price target based upon averages across Wall Street. The stock now trading at $451. And what we know is that this is an online, or rather, online used car market. And also keep in mind, right now, used cars are high in demand. They're typically a better bang for your buck, or rather what exactly Americans are looking for right now. There's also less used cars because of the fact that during 2021, 2022, post-pandemic, the ramp up of new cars weren't as, there wasn't as much supply as we currently are delivering in production. And so this has been quite a long time coming, seeing this run up of Carvana. And they said, the executive said on the call, they were once again the most profitable and fastest growing automotive retailer. And once again, they are up by significant margins. And so it's just interesting to see how this company has been able to make its way away from that meme stock trade and really come into its own.
All right, moving on. Let's turn to Strategy as well, because shares, they're rising as the company snatches up nearly $1 billion worth of Bitcoin. So this one, Brooke, so they buy about $963 million worth of Bitcoin between December 1st and December 7th. Bloomberg is noting here that's the largest acquisition since July. Its Bitcoin holding is now worth more than $60 billion.
Yeah, and keep in mind, they bought it at 90,615. So that would actually be below the current trading valuations. Have to take a look to where Bitcoin is now, because it really has been quite volatile in the past month. Bitcoin now trading around 90,525. Keep in mind, though, over the last month alone, Bitcoin is down more than 11.5 or around 11.5%. And when you think about where Strategy plays within this, Strategy now has Bitcoin holdings of more than $60 billion. This company really considered like a Bitcoin treasury sort of sorts. And the street, though, is still largely bullish on. There's 15 buys, 3 holds, and 1 sell. And when Michael Saylor, who is at the helm really of the chairman of Strategy, when he didn't even jump into this low point within Bitcoin, there was some concern. And so now we're seeing that sort of momentum continue for them.
Yeah, remember what Saylor told Yahoo Finance and Invest this year, Bitcoin will be bigger than gold.
Yeah, so he had to jump
in a decade.
In low.
No doubt in my mind, he said. Believer. All right, lastly, Wave Life Sciences announcing positive data for its obesity treatment. So this one, okay, positive results for the obesity drug. Truist weighing in here. I see them cited as saying we view the results as impressive. They say they should bode well for longer term data in Q1 26. Street loves this name, by the way. 15 buys, 1 hold, I see zero sells.
Yeah, and today alone, I mean, this is pretty crazy. Up 156% today alone. So quite a trading session for this company. But I was thinking sort of about the ramifications of the weight loss industry and what we see. It's surprising to believe that 2 years ago, to bring up Yahoo Finance's company of the year then, it was Novo Nordisk. And to think about how these weight loss drugs have sort of came into new iterations, this one clearly is something that the street is excited about. I mean, they said that within this study, there's a 9.4% drop in visceral fat, a 4.5% reduction in total body fat, and a 3.2% increase in lean mass. So these are clearly the results that the street seems to be liking, maybe a differentiator from what we've previously seen with Ozempic or Wegovy. Also, think about it. Novo Nordisk is down about 60% compared to a year ago. We also have Eli Lilly's Mounjaro also doing really well right now. So definitely this company getting in seems like a sizable competitor within that market.
All right, Brooke DePalma, thank you. Appreciate it. Coming up, we get the latest on President Trump's package to help us farmers next on Market Domination. President Trump unveiling a plan to help U.S. farmers as tariffs weigh on the sector. Joining now with the details is Yahoo Finance Washington correspondent Ben Werschkul. Ben, my friend, what do we need to know?
Yeah, Josh. So this is a $12 billion announcement from the Trump administration today for farmers that will go out in the form of checks directly to farmers over the course of the next 14 months. Trump just held an event at the White House to talk about this, and he talked about how this money would not be possible. This money would not be possible without tariffs because he's going to fund it from his tariff revenues. The issue here is that a lot of farmers have been saying for months now that this bailout wouldn't be necessary without tariffs because the need here is from Trump's trade wars and China's retaliation. Of course, Trump has launched a lot of his tariff threats. China has retaliated by moving soybean purchases to zero for much of this year. Detente with China has resumed soybean purchases, but it's taken a while to go up. But so this has led to a historically bad year for farmers. That is why Trump has to step in now with another farm bailout, as he did in his first term. As for how this works, this is $12 billion. $11 billion of it will go out as part of the main program. What the Trump administration is promising is that that farmers can apply essentially in the next few weeks, and they'll get a sense of what their check is going to be. The checks themselves will go out between now and February of 2026. The remaining $11 billion will be held aside for farmers who fall through the cracks of this first one in what the Trump administration is calling specialty crops. There's a lot of rules in terms of how this money goes out. The larger question here, I think, is whether this $12 billion will be enough. A lot of this number has been floating around for months now as sort of the size of this bailout, and we've heard a lot of farmers say the year was so rough that they might need more in the years ahead. The Trump administration in the first term did have to do a couple waves of this, so we'll see how this plays out over the next couple of years for certain.
And Ben, while we have you, Trump also teasing an executive order to come this week on AI. What's expected to be in that order?
Yeah, so this came in a Truth Social post this morning where Trump reiterated his position on this about the need to ban states from regulating AI in any level, basically leave it all to the federal government. He said that state level regulations could destroy AI in its infancy, is how he put it. And what he said he's going to announce this week is what he's calling a one rule executive order, essentially one rule put in place by Washington, not at the state level. But what's important about this announcement is this comes after efforts this entire year to implement this idea on Capitol Hill have failed. This was an idea that they wanted to get into the one big beautiful bill, kind of at Trump and his allies' behest. It got stripped out. They wanted to get into an end of the year defense bill. That also got stripped out. That bill was formalized early this week and is going to be voted on without any ban on state regulations. This comes even as there's been intense lobbying from Trump, but also from the tech industry here. We saw Nvidia. The Nvidia CEO was on Capitol Hill just last week, lobbying in part on this provision as well. The opposition here comes as senators representing states like Tennessee are very, very loyal to their state's laws on child safety, things like that would be supplanted by this. So they've been able to keep it out of the force of law. So now it's going to be this executive order, and the question will be how far Trump can go in an executive order format. The whole idea of doing it as a law is that it has more force as a law, how much he can actually stop states from regulating AI just with a stroke of a pen as opposed to a whole law.
Ben, thank you. Appreciate it.
Sure.
Well, President Trump at the Farmer Roundtable at the White House announcing plans that he says will help make farm equipment less expensive for farmers.
We're going to also give the tractor companies, John Deere and all of the companies that make the equipment, we're going to take off a lot of the environmental restrictions that they have on machinery. It's ridiculous. You buy it, it's got so much equipment on it for the environmental, it doesn't do anything, except it makes the equipment much more expensive and much more complicated to work, and it's not as good as the old days.
Joining now on this and a whole lot more, we have Deanna Kovar. She is John Deere, president of its Worldwide Agriculture and Turf Division, and is responsible for the American and Australian markets. Plus, Morning Brief host Julie Hyman joining us as well. Welcome to you both. Deanna, it's great to have you. Let's start there on these Trump comments, saying his administration will remove environmental restrictions, Deanna, that he says make ag machinery too expensive. You heard that? What'd you make of that?
Well, I'm not sure of the details behind what President Trump said, but at John Deere, we're here in New York City because it's really important for us that we help our customers, the farmers who grow the fuel, the food, and the fiber that every one of us needs every day. We're helping find ways to make them more profitable, more productive, and more sustainable. Every day looking for ways that they can grow more of that food, fuel, and fiber with less input. So profitability on the farm is key for us. And today's a big day for agriculture, having the announcement of this bridge package that will allow our farmers to bridge themselves to a lot of the great trade deals that this administration has put forward, and a lot of the work going on to ensure that there's ample markets for our customers' crop. Because we heard that from the president today too, that farmers don't want these types of bailouts, that they're looking for markets and access where they can sell their crop all over the world. And we're excited for all of the trade deals that have come through. And every day we're working hard to make sure that our customers can become even more profitable and even more productive.
And it's been a tough year for farmers, as you alluded to, both because of just some of the dynamics of the market that we've seen. Agriculture tends to go in cycles. It's not been a great time in this cycle for farmers. And then add to that the closure of Chinese markets, particularly for soybeans. And I know the administration's working on getting it open back up, but it's not quite there yet. So tell me what this new aid package means for your customers and what kind of material impact you could potentially see as that flows through.
Sure. Commodity prices all over the world have been under pressure over the last 24 months. And the American farmer has certainly felt that as interest rates have been higher, as input costs have stayed a little sticky for them as well. So this aid package really gives them some certainty as they go into planning for next year's crop. You know, every year a farmer has to make decisions about buying inputs and how they're going to go about farming for the next year. So having this aid package, knowing that number, will help them bridge through to next year when a lot of the benefits of the One Big Beautiful Bill, that increased reference price payments for our farmers, as well as some of these trade deals come through, it'll allow them to get through the next several months before those benefits start to accrue to them.
Deanna, how would you sort of characterize the real state of the ag cycle right now? Like now, and looking at based on what you're seeing in your business in terms of orders and channel inventory, how would you characterize it?
Yeah, it's definitely under pressure. It's been under pressure for a couple of years. You know, we believe that we're finding a bottom on this cycle.
Why do you say that, Deanna?
Well, there's a lot of positives coming for the farmer, especially as you think about the North American farmer. We expect rate cuts to come in the future. We'll see what happens this week, but certainly over the next few cycles, we expect interest rates to come down. We know interest is weighing on agriculture today. We're seeing fuel prices come down, but more importantly, we're seeing these trade deals get inked. And certainly the China trade deal is a big deal, and we expect that those soybeans will start to flow, but there have also been a number of other trade deals in Southeast Asia with the UK, and it's grains, but it's also fuel. And that's another reason that we're optimistic about the future for agriculture, because one of the best ways to drive a cleaner future for us is not necessarily electrifying cars, but it's using bio-based liquid fuels that come from soybeans and corn and reduce emissions by 50%, but also create great markets for our rural economies and for farmers. And if you think about on-road, off-road, aviation, there's a huge opportunity in the future. And recent changes in Washington have improved the outcomes and the outlook for renewable diesel and ethanol. And we're optimistic that the administration will also pass year-round E15, which will also drive even more need for corn and ethanol in our on-road vehicles as well as we move forward. So all of those things point us to the future for agriculture is great. At John Deere, we get up every day bringing amazing equipment, cutting-edge technologies, and the best dealer support channel in the world to support our customers as they find those next opportunities to make their farms even better.
Deanna, as the president alluded to, that great equipment and high-tech equipment you guys are making, it ain't cheap in many cases. It's gotten more expensive as it's gotten more advanced, as it's able to do more. And I know you guys have really focused on precision agriculture. What does pricing look like this year? What do you expect it to look like next year? And when you talk about the pricing inputs, how you decide to price one of your tractors or piece of equipment, is there environment? I know you don't know specifically necessarily what the president was talking about, but I'm just curious, environmental regulations, how does that feed into it in a more general sense?
Yeah, well, we're certainly always looking at the value that our equipment creates, our equipment and our technology creates for the farmer, and that's how we work in identify what the pricing can be. We certainly want to make sure that the farmers can be successful. We're only successful when they're successful. So our pricing always contemplates what value we can create. As we've made more precise equipment, as we've been able to lower fuel intake, as we've been able to lower input costs like fertilizer and seed because of the precision we're creating, we're sharing in that value with our customers because, again, we want them to be more profitable, productive, and sustainable, and we want to support our business in the long run. So we're always looking at that value share equation.
So what has pricing done this year? I mean, in general, on sort of like for like?
Yeah, so in 2025, we were net price positive, just under a point in 2025, and that's on a global basis, so it's different from market to market. As we look towards 26, we've recently just indicated that from a production and precision ag standpoint, that we'll also have about 1.5 points of net price realization going forward. But again, that's a global number blended around the world as we look at how we think about going to market in every market around the world.
Deanna, great to have you on the show today. Appreciate it.
Thank you.
And Julie as well. Thank you both. Coming up, Confluent shares surging as it's set to be bought by IBM. We get all the details on this deal. Next, stay tuned. A major development in the U.S.-China tech battle. The Commerce Department is preparing to allow exports of Nvidia's H200 chips to China. It's according to a new report from Semaphore, a significant shift after years of tightening AI chip restrictions. For more, we're bringing in now Yahoo Finance tech editor, Dan Howley. Dan.
Yeah, Josh, this is a huge move. The administration had been trying to get the movement as far as chips go from the U.S. to China. You'll remember they previously banned the sale of the H20 chip, which was basically a degraded version of the H200, and then they reallowed it. That was, the Biden administration stopped it, then the Trump administration was going to allow it, then they didn't. Then they said, you can, sell this into China, but, kick us up 15% of the sales of that. China, however, hasn't allowed those to be imported. They basically think that they're, just a degraded version of the higher end chip and say that, look, we want better options. And so this seems to be kind of threading the needle between giving China what it wants and kind of trying to appease folks in Washington who say that, look, if you give China high-powered chips, they're just going to develop high-powered AI and, either win economically or militarily using those for some kind of, they're in the army or things along those lines. And so that's been the back and forth. And this seems to be kind of just threading that line between folks who don't want Nvidia to get any chips and those who say, if you don't give China any Nvidia chips, then you're not having them rely on a U.S. technology, and you're also making it so that China will have to build its own chips, and then potentially those could proliferate, and the U.S. is unseated as the lead when it comes to AI chips. And so it's this back and forth that's been going on. Senator Elizabeth Warren has been critical of this. She basically says that, this can't go through. There are a number of other lawmakers who feel that way as well. But then there's others who say, get the chips out there and let's see what happens as far as ensuring that the U.S. stays in the chip lead.
All right, Dan. Thank you. Confluent stock is soaring on news that IBM is buying the company for $11 billion. Confluent will be part of IBM's software unit as the company looks to boost its AI offerings. Confluent's CEO and IBM's Senior Vice President of Software both joined Market Catalyst this morning to discuss that deal.
I think we're at a unique moment in time with everything happening in AI. Our projection is there's going to be 1 billion new applications built using generative AI over the next 5 years. And that needs a data platform to feed it intelligence. And Confluent is without a doubt the leader in real-time data, how you can connect the data, transport data, and then process data. And they have an incredible track record, over 40% of the Fortune 500 today. We think this is the perfect time to bring Confluent into IBM and bring it to the whole world.
And for you, Jay, help people understand a little bit what Confluent does, because I think for people who are not steeped in the sort of pipes of how generative AI works, they would think, oh, well, isn't real-time data just like part of it? But it doesn't just sort of magically happen. So talk to me about how it happens.
Yeah. You could think of Confluent as kind of like being pipes. It's ultimately about how does data flow across the different parts of a company between all the different applications. How can a company kind of act and react to what's happening in real time? Yeah, it's a big deal for a lot of these AI applications because they're fundamentally about bringing context to data together, in real time to be able to feed these models the right information to make good decisions.
And Jay, why did you guys decide that now is the time to say yes to IBM and not remain an independent entity?
Well, IBM has an incredible track record with open source and with acquisitions and really accelerating them. And I think it's done an amazing job of building an open platform for hybrid cloud, for applications around security that has taken these acquisitions and built something that really makes sense for customers. And, I think to me and to Rob, when we thought about kind of adding, a layer that was open around data and the flow of data across the company, we felt like, hey, that makes a lot of sense. And when we thought about our customers, that's what they're looking for and the problem they have to solve as they think about really harnessing this data for the next generation of AI and applications and development they'll be doing.
Rob, talk to me a little bit about the financials behind this. I know you say in the statement that the acquisition is expected to accelerate IBM's growth over time. Maybe you could put a few more numbers around what exactly that growth might look like. And I also should note, Confluent is now does not make a net profit at this point. So I wonder what that trajectory is going to look like under IBM.
Confluent's a very successful business. So $1 billion of revenue growing 20%. So we're very positive about the fundamentals of this. And we also said that this will be accretive to IBM's free cash flow in year 2. And so we're going to look for synergies as we do this, but we're going to continue to invest more into what they're doing in R&D because they've got the leading product, leading platform in the world for real-time data. And then we'll look for different opportunities for synergy as we go too. But the fundamentals here are very good. And I'll tell you, we're impressed by how they've moved towards a consumption business model as well. So they're really hitting clients with the way they want to consume technology, which I think is great.
So just to get a little bit more specific there on that profitability piece, the growth and the size of the revenue at Confluent, Rob, totally get that. When you bring it under the IBM umbrella, do you switch, how quickly do you switch that on to profitability?
Well, we haven't changed our model and our guidance, but as I said, we'll be free cash flow accretive in the second year. So we're going to be aggressive about thinking about how do we optimize the business model of Confluent in IBM, but we do that right away, just like we did with HashiCorp, just like we did with Red Hat before that. We're really focused on how do we get synergy quickly.
Jay, you guys compete with some of the hyperscalers with your business. Now that you're going to be owned by IBM, kind of how does the pitch to clients change or does it not change to sort of reassure them now that you're owned with a company that competes with maybe some of your clients on some fronts?
Yeah, I mean, there's some products within, the major public clouds that we would compete with, but there's hundreds that we actually cooperate with. So we think about the hyperscalers as partners. Our platform connects into many of their offerings and would drive the flow of data and consumption out to many of their AI and data services. And so even though, there's a handful of products that we would overlap with and compete with, by and large, we see it as complementary. And I think that continues as part of IBM.
And Jay, I'm curious, as you sort of visualize what Confluent looks like with IBM, is there a hero product that you envision, having the two companies coming together that you're going to be able to offer to customers?
Yeah. I think the vision, is very much an extension of what Confluent has helped to date, which is to really provide a fabric across all the parts of the company, right? The different clouds that they live in, data centers out on the edge, where data can flow in real time, that connects all the parts of their business, that they can act on, that they can bring intelligence and AI to. This is what we enable. I think we're now able to do this as part of a bigger story for some of the largest customers in the world. And I think it's a really exciting thing.
And Rob, finally, expect any kind of regulatory issues with getting this deal through?
No, we're very confident. We'll go through all the process because we want to do things the right way, as we always do. But expect that, as we said this morning, hopefully we'll close by the middle of 2026, and then we'll be off and running.
Don't go anywhere. We've got you covered with all the action following the closing bell on Market Domination Overtime.